Buenas tardes, bienvenidos a Invertir como Profesional. Hoy en entrevista, ya sabéis, los jueves hacemos directos, entre semana a veces hacemos entrevista. Hoy tenemos entrevista a Marc, que es CEO de Ecora. Ya lo veo conectado. Por tanto, ya sabéis que estas entrevistas son para vosotros, para que hagáis preguntas al final de la sesión. Hoy vamos a hacer un update porque es la segunda entrevista. Como siempre, antes de empezar la entrevista, ya sabéis que Invertir como Profesional no ofrece ningún servicio de inversión, no ofrece asesoramiento financiero y que cualquier opinión aquí expresada por mí, o en este caso por Marc Bishop, pues siempre es con carácter totalmente educativo y nunca hay que interpretarlo como una señal, una confirmación para comprar o para vender. Los precios objetivos expresados aquí representan un valor subjetivo y están sujetos a los riesgos habituales de mercado. Repito, en ningún caso esto supone un servicio de análisis, recomendación o servicio de inversores. Voy a dar paso a Marc. Marc, hello.
Hello, how are you, sir?
I'm fine, thank you. And thank you again to accept this YouTube interview. This is the second time. So I think last interview was 1 year ago. I received many questions about Ecora, and I think people right now understand better what means Ecora. But as a way to start, if you can explain what is a royalty company and make some description of the Ecora business, and then we can go directly to this year and the outlook for next year.
Sure. So I'll keep it brief in terms of what a royalty company is. And if you'd like a bit more detail, just let me know. But in a nutshell, a royalty company is a vehicle that acquires rights to receive a percentage of the sale price of minerals when and if they're extracted from an underlying area. And so we as a royalty company have gone out and are in the process of continuing to buy royalty rights over producing mines, over development projects, and as and when these assets sell product, we receive a percentage of that income. It's somewhere between, it's one step removed from investing directly into a mining operation or into a mining project, in that as a royalty company, we, by virtue of making that front investment, are not thereafter on the funding their ongoing project development. We're not funding the capital costs of building the project. And when you think about our revenue to the royalty company, it's derived from the revenue of a mining operator, which therefore means that our revenue is not subject to the direct costs of the extractions of those minerals. So that's a royalty company in a nutshell. And if you'd like more information on what a royalty company is, I just invite you to visit the Ecora website, where there's a lot more detail. You can see some of the transactions we've done in the past that will also can help familiarize oneself with this model.
Okay.
Ecora, go ahead, sorry.
No, continue, please.
In terms of Ecora, there are really two types of royalty companies in the world. There's royalty companies that are primarily focused on precious metals, and there's a big universe of that group. And Ecora fits into a second category, and Ecora really focuses on non-precious metals. Specifically, Ecora focuses on energy transition commodities, and by that, it's a very broad commodity basket. Effectively, what we're talking about is commodities linked to either renewable energy or low carbon energy, the transmission of that energy, and then beyond that, the consumption or the storage of the energy. So when you look at, okay, well, what does that actually mean in terms of the metal that we think about? Actually, it's easier to work backwards. It's easier to say, okay, we don't look at precious metals. We're not looking to deploy capital into hydrocarbons or fossil fuels, and PGMs, platinum grade metals, typically price as though they were precious metals. So we don't spend that much time in PGMs, although it's not to say we never would. And so by exception, the rest of the commodity basket is fairly open to us. We're focusing primarily on base metals, but there's a long list of opportunity outside of the commodities that I carved out just now.
Okay, thank you for this introduction, Marc. So let's go to the first trading update that you report a few weeks ago. So you have a good royalty income, I think more than 100%, no, in percentage terms, and you are expecting a good first semester for this year. So you expect to increase the volumes, no, the production. So can you talk a little bit with the main drivers of this Q update and the year?
Yeah, so over the course of this year, from a production perspective, the guidance from our partners who own and operate the mines suggests that we should see volume growth across the portfolio, which is great. Now, of course, whether or not that translates into pricing growth year on year will be a function of the weighted average commodity prices throughout the year. But to date, we've seen a good level of pricing across the basket for the most part. Copper obviously has done very well this year. Copper is a lower portion of our revenue. In the course of 2024, a lot of the portfolio's income performance will be tied to the one particular royalty, and that is the Kestrel royalty. So we've seen and we anticipate that most of the volumes within our royalty area at Kestrel will be mined over the course of this year, over the first half of this year, such that price levels have been certainly not at the record levels that we observed in 2022, but still fairly robust, ranging between 300 plus in Q1 to now being in this quarter somewhere between 225 and 250 per ton of metallurgical steel making coal.
I think you talked that, Marc, that met coal royalties, so Kestrel, it's going to wait just 10% from today, 3 years in advance, right? This idea, no? In 2006-7, this percentage is 10% or less?
Yeah. Well, the Kestrel is an interesting royalty. And for those who don't know Ecora, it's probably important to mention that if you looked at Ecora 10 years ago, this business was primarily one royalty, and that was the Kestrel royalty. And it's a fantastic royalty. It's a great asset. It's generated phenomenal cash flows. One thing that we've always known, however, is that mining in this decade at Kestrel would move outside of our royalty area. And so that royalty effectively within our royalty area anyways appears depleted. And that is expected to occur in the next 3 years. And so we made a decision thereafter when we thought about how to replace the portfolio and took a view not in the next 2, 3, 4, 5 years, but actually over the next 20 and 30, what commodities are those that are subject to the most structural and attractive growth prospects? And therefore, we've really worked hard to reposition and rebalance our portfolio to provide, excuse me for a second, let's get the light back on, to get exposure to base metals, right? To these energy transition commodities that when you aren't necessarily priced at their scarcity levels today, when you look at the equity market valuations for a lot of these companies or the cost of capital to these types of metals producers or developers, but then when you look further ahead, have really attractive, as I mentioned, really attractive structural long-term growth demand drivers. Base metals are the core of our portfolio, of which copper as a percentage of our net asset value is the largest, followed by cobalt and nickel. So we're I think from a commodity perspective, we love the fact that copper is our most important growth area, especially when you look at recent copper market dynamics. And while today the business isn't as sensitive to cash flow from copper, when you look at our business over 5-10 years and beyond, really copper is the most important commodity.
In any case, for this year, coal royalties is going to increase volume because I think you talk about 15, 25, 30% for the year, right? And met coal prices are so high, so are more than 250. I think it's 271. So it's going to contribute a lot to the P&L, no? So you talk about copper. So we can say that copper is the main commodity that you want exposure in the next 2-3 years, is it right?
Yeah, well, I'd say that we've already done a lot of work to acquire copper exposure going back as far as, we bought our first copper royalty in 2019. And the exposure that we've accumulated over that time has been part of a longer term strategy, not to start buying copper when commodity prices improved, but really to build our exposure to that commodity, and also do it over really high quality projects or operations with strong partners. So our copper exposure, our key partners are Capstone Copper, which many of your viewers may be familiar with by virtue of their operations in Chile, BHP, copper and nickel project in in Australia, and we have also other sources of copper growth beyond those two royalties. So yeah, we've really worked hard to position the portfolio to benefit from expected what we're seeing already in the market around copper, as opposed to just starting to do it now.
I think the main asset here in copper is Santo Domingo, right? I think it's the large contributor to future growth, right?
Yeah, as part of our NAV, Santo Domingo is indeed a very important royalty for us. Capstone Copper has indicated that they'll be releasing an updated feasibility study for the Santo Domingo project, incorporating some of the synergy potential that exists between the Santo Domingo project and the very nearby Manto Verde mine, including, for example, infrastructure such as desalination capacity. So that's one that we're really excited about, and that we don't really get much credit for in stock price today. In fact, you haven't asked the question, but I'll still say it. One of the areas I think that most gets overlooked about Ecora is the copper exposure. And in part, maybe that's because the copper exposure is not like an immediate aspect of the story. It's more of a medium to longer term aspect of our growth profile.
I think the Santo Domingo asset is going to, so you're expecting some news this year, because you're expecting for the first semester the feasibility study. So if all goes well, when this asset came into production?
Well, we'll have to see what Capstone says, of course, when they release the updated feasibility study. Historically, Capstone has indicated that they're targeting a final investment decision to proceed with that project next year in 2025. And in terms of the construction period, based on prior feasibility studies, sort of 2 years, but again, we'll see how that may have moved when they are in the latest round of technical work. So assuming a final investment decision in 2025, theoretically that could put one on track for first income in 2027. Could be later, of course, but that's sort of the base case as per current Capstone Copper disclosure.
Okay. Can you talk a little bit with Voisey's Bay, because you are going to receive this year some cobalt derivatives? I think it's in a range of 12 to 16, and it's more linked to the second semester than the first one. So can you talk a little bit?
Absolutely. So for those who aren't aware, in 2021 we acquired a cobalt stream over the Voisey's Bay mine, which is located in Canada, owned and operated by Vale. The Voisey's Bay mine has been transitioning from historically above ground operations to underground operations. And over the course of this calendar year, some of the final pieces of that construction and that underground mine life expansion are expected to complete. In the first half of the year, we anticipate, based on Vale disclosures, that some of the key infrastructure associated with the Reed Brook deposit will be completed, which should help underground throughputs. And in the second half of the year, materials handling systems associated with the other main deposit, which is Eastern Deeps. And the reason this matters really is that the key for our volumes at Voisey's Bay in terms of cobalt is higher throughput of the material from the underground. Because the last 2 years, plus or minus, most of the material has been coming from above ground, but a much lower contained grade of cobalt. So by virtue of swapping out, the same tons of ore, but with underground material, that's expected to drive a big uptick in our cobalt deliveries from the stream. And it's not just about, it's about ton for ton, but also increasing throughput as well. So to give you an example, at Voisey's, over the course of this year, we anticipate receiving somewhere between 12 to 16 deliveries of cobalt over the course of the year. on average, right, at a full production capacity, that gets closer to 40 deliveries per year. So from here, it looks like 2024 will sort of see some step up in volumes, but that really should accelerate based on the current plan as we understand it in 25 and 26.
Okay. Here in this slide that there are much information, you are related to NAV, but you talk about your geographic exposure, your commodity exposure, and your cost curve positioning. Do you have some targets, internal targets, goals for these different things? So you are linked to tier 1 zones like North America, Australia, and some countries of South America. You own Cooper, but so can you concrete a little bit? So, for example, you want 50% Cooper in your net asset value in wage, or can you go for more first quartile cost curve like 40%? Is it going to increase? Can you explain a little bit these metrics?
Yeah, so loosely speaking, what we're looking to do purely from a cost curve positioning, let's start there. We're really looking to build a portfolio of defensively positioned royalties or projects that once in production are expected to operate at the low end of industry cost curves. And it shouldn't surprise anyone that we're looking to do this. We see volatility in the mining sector, and as a royalty holder, we think building a portfolio that can withstand that volatility, that is underpinned by mining operations that can generate strong cash flows through cycle, is really important, and that's what we've looked to do. That's what we've looked to do, and we continue to look to do that. And in some ways, I feel we've done a good job, right, of growing this business without sacrificing on cost curve positioning or on jurisdiction. I think one of the things we're all aware of in mining is that jurisdictions matter. And they matter in as much as just getting a project into production, having a streamlined permitting process, having streamlined environmental closure plan process. So these are all really important. And to date, we've seen a good amount of opportunity in OECD countries as well as Brazil. And we're really happy and comfortable with that footprint. It's not to say that we would only ever invest into an OECD jurisdiction, but to date, that's where we've seen some attractive opportunities, and we've been able to keep this portfolio, as I said earlier, and grow the portfolio without having to sacrifice on either of those fronts.
Do you think that some of the problems with some of the investors that could invest in Ecora is the short-term view? Because if you see the commodity prices, not all the commodities, because Cooper is in all highs, but not the others. So do you think that people need to look more at the mid, long term and not the short term to try to understand the transformation that Ecora is doing?
I mean, there's a few dimensions as to why Ecora, not just Ecora, but many companies, for example, in the UK, or companies connected to the energy connected to the mining sector have come under pressure. And it's interesting that some of the factors from a macro perspective, some of the same factors that really weigh on the Ecora share price, funnily enough, are the same factors that often contribute to attractive environments to deploy capital, because those factors often really highlight the merits of the royalty partnership. Today, for many mining companies, and not all, of course, but for many, or project developers, a royalty is a fantastic source of non-dilutive financing to continue to develop the project. The alternatives could include very expensive equity, so potentially very dilutive, and debt, of course, today is very expensive if it's even an option. So, to answer your question directly, yeah, I do think that some of the factors that are sort of from a macro perspective, uncertainty in the general global economy, rates, interest rates, direction of travel. We're in a time where there are 2 wars happening in the world at the moment, although one of them may not officially be deemed such. But in any event, there's a lot happening around us, right? So that's, in our view, really the time when we should be looking to support mining companies and to deploy capital. To be successful in the natural resources sector, in my opinion, a lot of it comes down to cyclical timing, but that's especially the case with the royalty. because in an equity, someone can trade in the equity, they can trade out of the equity. As a royalty company, generally, we make these investments and hold them for life. So if we get the entry point wrong, through cycle, very hard to generate attractive returns on that basis.
I appreciate so much, Marc, your effort to increase your capital allocation framework. So here, this slide is really interesting. So you are focused to leverage the balance sheet, but most important, at least for me, is that you expect to have a 25-35 free cash flow that you're going to report to shareholders, no, in dividends or buybacks. So when you talk about this percentage, are you talking in the midterm? Are you talking for this year? Can you concrete a little bit this number?
Yeah, the first point to make is we thought very carefully about the updated capital allocation framework. The reality is, many of our shareholders really valued the certainty of a fixed dividend paid on a quarterly basis. And this wasn't an easy decision to make, but we did make it after careful consideration and really putting the business's long-term interests at our core. And from where we sit today and from where market conditions are, as I mentioned, it is an attractive time cyclically to keep growing. And I think the other thing that we see in the share price performance is that, yes, we've done it. We have moved the business forward in terms of reducing the reliance on Kestrel and adding an element of growth beyond that. But we're still far from being sufficiently diversified to really, from what the market's telling us today, attract a premium royalty company equity valuation. And so our view is to achieve a premium equity royalty valuation, the solution is to be more diversified. And of course, while maintaining high quality assets. So that meant pulling back on the level of cash distributions and aligning the level of distributions from a fixed amount to a percentage of the free cash flow organically generated in the business. And going forward, so for example, applicable in terms of for 2024, what we'll do is we'll take the average of the two trailing half-year periods of free cash flow, and then from there, that 25 to 35% of that will be earmarked for distribution, which will translate to a per share number.
Okay. In terms of buybacks, you are completed the last buyback announced. I think it's 4% shares. This is not for cancellation, right? It's for maintaining treasury. Are you consider to make these shares for cancellation? That's possible.
I think we've been pretty clear in demonstrating that at these share price levels, we're certainly not issuers of the equity, and we are buyers, right? There may come a time in the future where the share price is at a level that more closely represents the estimated fair value or net asset value of our royalty assets. And in those circumstances, would we potentially consider monetizing those shares to fund further growth? Absolutely. But at this time, we're not contemplating issuing equity at these levels.
Right now, you have 150 million liquidity, right, with the undrawn revolving credit plus the cash. So is it an option to, if the stock continue to go down, to implement a second buyback? That's an option, or it's not in the table right now?
Yeah, it's not something that we're considering at the moment. We've just recently concluded the last buyback round. And if you look ahead over the next couple months, there are certainly some really exciting developments expected to occur. So we've spoken about Santo Domingo already. There's other news in our portfolio in August, specifically on the timing at West Musgrave that investors can expect. We're expecting to see a ramp up in volumes over the course of the H2 and beyond at Voisey's. And there are other things that are pretty material in whole, while not necessarily as individual line items, that I would be surprised if we didn't see a share price reaction. So at this time, we're kind of waiting to see how the equity trades and how things develop. But as part of our capital allocation framework, we've been fairly clear that while we may not be doing it specifically now, as a general principle, we would consider share buyback programs if the delta or the differential between market price and estimated net asset value is sufficiently broad to yield some really attractive per share accretion and actually per share dividend growth as well.
It's an option to sell the remaining Liork stake and the other investments that you have right now. It's a small amount. I think I checked the balance sheet. It's just 3 million, no, I think. So, but that's an option to sell these stakes and reinvest in the own company.
Yeah, in the past, we've thought pretty creatively about the Labrador Iron Ore Royalty Company stake that we've had. So we monetized a portion to part fund the Voisey's Bay Stream acquisition. More recently, last year, we part funded a royalty acquisition, which was some of the proceeds of a sell down in that position. And actually some of the cash, well, not dollar for dollar, but that we monetized last year, in our minds anyways, we sort of see it as a capital recycling exercise from LIF to this buyback. But could we consider monetizing that stake in the future? Yeah, I think we've been pretty open and pretty clear that we would see that as a source of liquidity to fund further growth potentially, whether that be royalty and streaming acquisitions or share buybacks. In some respects, both of them drive per share metrics growth.
Can you explain this slide, Marc? Because I think it's so visual about what the price is discounting today. Okay, can you explain it with some detail, please?
Yeah, I mean, what this slide is effectively saying, right, is that the market is applying a risk factor to a producing asset base. It's greater than 1. And then thereafter applying a risk factor to anything that's not in production of 0, which is, you know, this is fairly unusual in terms of how Ecora has historically traded with reference to the estimated net asset value. I guess it's a signal that, you know, the market is at this moment anyways, not allocating much value to anything that's not in production, and that entails development risk and construction risk and timeline uncertainty. I think on the flip side, for anyone who's interested in Ecora, at these levels, it does appear to be a fairly exciting entry point, in that one can come in for the value of the producing portfolio. And at these levels anyways, it appears one could get the rest of the portfolio as upside, which seems really compelling. So that's partially why, you know, when we look at what was priced into the Ecora shares earlier this year, and the gap, right, from where we trade today to the estimated net asset value, that really supported the decision to proceed with the buyback earlier this year.
In your opinion, Marc, what can do more Ecora to increase the visibility of the company to the investors? What you can do more?
You know, I think there's a lot we can do, but I think the thing that'll make the biggest difference, and who knows, maybe I could be wrong, but honestly, I think that, you know, what matters most to investors today is better visibility on what the timing is to West Musgrave and Santo Domingo. Because, you know, when you look at the business today, Kestrel is certainly not going anywhere. Right? We expect volumes from Kestrel in 25 and 26. But I think, and most people are comfortable that Santo Domingo and West Musgrave will come into production, or at least that's our impression, although that's purely anecdotal. The question we often get is when. And so, you know, over the course of the next couple months, with an updated feasibility at Santo Domingo and with more visibility from BHP on when at West Musgrave, I would have thought that those are two really material catalysts that, of course, we can do a lot to communicate and to market thereafter. But as a starting point, I think that's we often get questions around those timelines.
Okay, I like this slide because you talk about some revenue guidance for the midterm. You talk about 100 million, I'm not sure if you don't disclose guidance in terms of EBITDA or free cash flow for the same long-term view.
Yeah, we don't, because it's challenging, right? It's challenging in that, well, what commodity prices does one assume? And most folks, have their own views on what commodity prices they want to apply, not only in the short term, but in the medium term and the long term. I think this is a great slide, though, to illustrate two things. I think this slide illustrates, number one, just the revenue potential of the portfolio we have that's already in production. So in other words, what could the revenue of this business be without Kestrel, assuming broker consensus, commodity prices, and also assuming a broker consensus view on volumes. And I think the next thing that this slide illustrates is that the business has really exciting potential to hit an exciting level of revenue, primarily driven by copper. Currently, it's highlighted as medium term, right? And as I've just mentioned, getting more visibility on exactly when that medium term is, I think is going to be really well received. So Santo Domingo targeted 27, 28. West Musgrave is 21% complete, previously targeted for 26. Is that 27? Is it 28? Is it 26 still? I think once we can firm up, and once we can communicate more firmly whether what that medium term time will look like, I think there'll be a lot of interested parties to better understand what that means for this business, especially because we have a slide in our results presentation that talks about our trading multiple and the re-rating opportunity. And the Ecora sort of growth story is driven by two dimensions. The first is what you see on this slide, which is just absolute growth potential, which is exciting. I mean, to think that we have the ability to hit these levels of revenue based on the organic growth we already have in the business. And of course, we're looking to buy new royalties and to further grow that way. And the second dimension is that we trade at a valuation multiple that I think in part is a reflection of the source of those cash flows, which a good chunk currently are metallurgical coal. And if we look at equity markets more generally and look and see how a met coal producer trades in terms of valuation multiples relative to, say, a copper producer, there's a disparity. And so time will tell, but there certainly appears to be good potential for our trading multiple to expand as the complexion of our revenue shifts from what's historically been primarily steelmaking coal, and in the future is expected to be primarily base metals linked to copper.
What do you think would be a fair EBITDA multiple for your company, Marc?
Everyone will have a different view. And so what we've done on this slide actually is show a range. So on the right-hand side of the slide, what you see, so this slide at the time, we're trading at 6 times EBITDA. And by the way, one can debate whether EBITDA multiples are indeed even the correct way to value a royalty company. But again, putting that aside, we've shown a range of 6.2, which is where we trade, and we've shown the 20 times multiple, which is where our closest peer trades. And that's not a precious metals royalty company. That's a royalty business focused on commodities similar to Ecora. So there does appear to be quite a lot of upside potential in the equity, even if you just assume you get a third of the way there potentially, or halfway there. It's a big gap. Where we get to, I would hope we would be higher than 20, but time will tell whether that's achievable.
I think the company needs a rating for 2 things. One, if this, but the other, if the investors think that Ecora is a met coal royalty company, I think so. I'm investing in met coal companies, so I know the strong demand from Asian countries, especially India. So these companies, I think, is going to rate in the next 6-12 months. So if this is clear, so if this is like this, so Ecora should have some rating for this part, right? So I think maybe the Ecora is in the mix of a met coal royalty company in transition, and investors don't understand that, right?
Yeah, so, and that's a really important point, right? Like 10 years ago, we were basically only a met coal royalty company. today, we're a royalty company that has a lot of its revenue generated from met coal, but our asset base is generally, base metals amongst other commodities. And one of the slides that we showed in this pack is just about our NAV evolution, right? So a lot of our NAV today, especially compared to historical levels, is with respect to royalties that are not yet in production. So we're sort of a year and a half into what is probably a two to 3 year transition period as Kestrel goes from being the most dominant asset, certainly in terms of revenue. Already it's not dominant in terms of NAV, but at the end of this period you would have the revenue complexion matching the NAV the NAV complexion.
Let's talk. Well, you talked before, but let's talk with more detail with the catalyst that Ecora can have this year and next year. So I think this slide is good to think which news we can have for Ecora. So can you explain a little bit, maybe the most important from this slide?
Yeah, well, let's start with Voisey's, and I touched on it earlier, but over the course of 2024, a current expectation based on information from the mining operator is for 12 to 16 deliveries of cobalt over the course of this year. And that mine is expected to ramp up thereafter. As I mentioned, at sort of average steady state life of mine full capacity, one would expect average deliveries of 40 per year. So that's a big increase at Voisey's, and I think generally speaking, folks who we speak with generally have a lot of questions about how that ramp up is going, and we're watching that very carefully. At West Musgrave, this is a mine that's in production, 21% complete as of the beginning of the year. And BHP has indicated that just given a weaker nickel market, they may look to slow down the project capex, and that which would thus delay the first production date. BHP has indicated that they will be giving further visibility on what they'll do at West Musgraves in their full year disclosures, which are expected in early August. The one thing that we think carefully about it at West Musgrave that's happening in parallel is that at spot nickel and copper prices, West Musgraves is something like, call it 40 to 45% copper and maybe 60 to 55% nickel. And so there's the copper angle at West Musgrave is really compelling. Santo Domingo, we've spoken about the feasibility study or the updated feasibility study, the targeted detailed engineering and sanctioning dates, and then the construction timeline. At Mantos Blancos, somewhat less of an immediate contributor to the P&L, but still very positive given this is a copper asset. We anticipate some level of volume growth at Mantos Blancos between H1 and H2 this year. And then thereafter, there's potential to further expand the production at that mine by a phase 2 expansion, which Capstone has indicated they may look to progress next year. POE is a growth option in our portfolio. We have the right but not obligation to deploy $62.5 million to part fund the construction of that project. The company is currently looking to secure construction financing, and that process is well advanced. Nickel markets have been obviously challenging. Despite that, the project's high quality and the efforts of the team have kept that process moving forward. We don't have total visibility or control over how that timeline progresses, but we've been really impressed by the quality of work of the team at Brazilian Nickel, and are hopeful they'll be rewarded in due course.
Marc, is there an option to use this 150 million financial flexibility for a big acquisition? Is it an option, or is it not in the cards of Ecora? So you want a small royalty sizes. So how do you think about this disponible money for M&A?
Yeah, I mean, look, you can, in my opinion, and this is, I personally think all else being equal, if you had two identical investment opportunities, right, you'd rather have two $50 million royalties rather than one $100 million royalty, simply because you have the benefit of diversification, different potentially counterparties, potentially different jurisdictions. So generally, it's not to say that we wouldn't consider a $150 million deal as a one shot, but all else being equal, if we could achieve 150 million of transactions via, $5 $30 million acquisitions, I'd probably prefer that. But in the real world, things are not so perfect, and finding 5 identical opportunities is clearly not realistic. But it's just to illustrate how we think about the merits of diversification. In terms of how big we can go, I would say I think it's a part of function as to whether or not the asset's in production. And if it is in production, what the cash flow profile is like. Because obviously, to do this would entail a good amount of leverage, right? We require upsizing the facility to trigger the accordion. And so you have to look at what the pro forma credit metrics of the business are, leverage ratios, and other factors. One thing that we're really mindful of is most folks buy royalty companies for de-risked exposure to the mining sector. By putting too much leverage onto a royalty company, we are mindful that one could erode what should be a de-risked way to get exposure to the mining sector. In theory, we could do it in one slug. Could it happen? Yes. Do I think it's likely at this second today? Probably less likely than more that, in the next weeks or months we would look to do a transaction of that size in one go. But, we'll see what develops.
Because I think at this valuation price, so royalty companies should to trade at 10 times revenues. Right now you are close to 4. So there are M&A in the sector. So there are M&A in the royalty business. So all is possible here. Let's go with some questions, Marc. Pablo Martinez is asking how is the thesis about copper? So which visibility you have about the copper and other metals for the energetic transition? So if you can speak a little bit more about copper.
I mean, there's a lot to like about copper, right? Just in terms of why you would be so. I mean, the first point to make about copper is it's a really big market, and there's some really well-established end market demand sources, right? That are far beyond just the energy transition. And effectively, what you're talking about is copper is tied to the consumption of any electrical power as a starting point. It's a big market. There have been periods where copper is traded very high relative to the best substitute for copper, being aluminium. And one could argue that a lot of the substitution that's possible has already occurred. Furthermore, supply amongst copper projects appears constrained. And how can you talk about an energy transition which contemplates electrical energy consumption without copper as a conductive material? So I could spend hours speaking about this exact topic. Conscious of time, what I'd suggest is that, excuse me, I would refer anyone who's interested in a specific topic to some of the materials we've put out in relation to the copper demand outlook, and furthermore, the copper intensity in terms of usage. In other words, how much copper is required, for example, for a wind turbine, how much copper is required in an EV relative to a combustion engine, how much copper is required for solar power installation, offshore wind. The intensity is much more enormous. So not only are we looking to build that capacity, but we're looking to replace other sources of power that are far less copper intensive. I'll stop there because otherwise we might make it well past the anointed time. But to the individual who asked the question, if you'd like to learn more, please just reach out to our IR function who can certainly pass on a lot more. There's a lot that we put out, also available in the public domain. We'd be happy to guide you towards.
The second part of this question talks about a possible recession and the price of copper. In my opinion, the price of copper is in all-time highs, so it's not discounting any recession, right? I don't know what is going to happen in 2025, but this is a clear risk, right? So a recession is going to decrease the demand for copper and also the price, right?
Yeah, I mean, one of the really interesting thing about spot prices is that spot prices effectively represent supply demand today, right now, this second. They don't really bake in expectations of future supply deficits. I mean, to a degree they do. You can see that maybe in forward pricing. But spot price is not necessarily always an exact indicator of structural demand deficits or oversupply, for that matter, for time, decades, or in the short, medium, to long term. Copper, of course, historically, one of the key drivers was construction in China, and that's already really been eroded over the course of this decade, anyways. You know, the electrification has really emerged as a replacement to the China urbanization copper sort of story and driver. You know, the reality is, if copper is indeed being allocated towards energy transition type initiatives, some of that spend arguably is less sensitive to economic factors, right? So energy consumption and the desire to decarbonize, there's an element of support that exists that doesn't always exist from a pure free market perspective. If one is talking about, for example, policy that's developed by national governments across the world. So we'll have to see how that plays out, because historically copper has just been so highly correlated with GDP, but there is a dimension of the energy transition which is somewhat insensitive, and that potentially can reduce the absolute level of correlation that has existed historically. But time will tell, I suppose.
Alonso Gomez is talking about, have you seen some reactivation in China?
Well, I guess do you think it's fair to assume that question is around construction activities or economic, or what sort of direction would you anticipate that the listener is looking to go in to make sure we hit the most pertinent points?
Okay. And last question, Jose Luis is talking about, we talked about that, but if you want to repeat or concrete something, what's your opinion about the Ecora price and why the market is not valuing the fair value of Ecora?
Yeah, I think there's a couple factors. I think number one, we've discussed it really, but this transition that we're in from what the company was, which was primarily driven by Kestrel. We know that, not through any decision of our own, the reality is the Kestrel royalty will deplete just by virtue of its exposure to a finite resource. So that transition that we've taken from Kestrel to something else is new and it's different. It potentially attracts a different investor base. So that's certainly one factor. I would have thought there's, in the UK, we're a UK listed company, and so in the Financial Times is covering this almost daily. The equity market valuations across the UK seem pretty beat up, for lack of a better word, relative to many of the other global exchanges for factors, purely macro, not Ecora specific. And then the last piece is another area that we spent a good amount of time discussing, and it's potentially some sort of risk-off sentiment in relation to any assets that are not yet in production. I don't think it's unreasonable to, based on when we look across the market, I would have thought that as these assets or our non-producing assets are incrementally de-risked over time, I would have thought that the equity value like Ecora stock should get some benefit from non-producing assets, maybe not 100% of the asset value of those royalties, but maybe somewhere greater than zero. And I suppose that's the opportunity for folks who like the direction, in other words, like a longer-term story tied to this commodity basket. Number two, like the growth profile, and have some sort of view on the quality of the counterparties that we have in our business, and their ability to not only run mines well, but also bring new mines into production.
Marc, are you planning any Investors Day? Maybe it could help with visibility in UK or in the US, so that's an option?
Yeah, we have considered that in the past. Ultimately, we're limited by what our counterparties and our partners have put into the public domain in relation to their assets. So today, we can't really say anything more than what's in the public domain. In time, though, we would certainly consider it. Really, though, what we would require is have something to say. And based on where we are today, we're still waiting a month or two before we have a bit more information on some of these key developments. But in the future, beyond that, of course, we would consider it.
Okay, there are no more questions. So, Marc, thank you for your time. So we are in contact and we expect a first good semester for Ecora.
Thank you so much for hosting me. It's a pleasure to be here. I'm delighted to speak about Ecora and look forward to hopefully being back on the show to update you in a couple months or beyond.
Okay, I hope. Okay, bye. Thank you. Bueno, pues hemos hecho un update cortito. No hace falta alargarlo más. Han habido preguntas que ya había comentado Marc, por tanto no había que repetirlas. Me preguntáis aquí por un poco la valoración. Ya sabéis que esto no son recomendaciones, simplemente es mi opinión, siempre con carácter educativo. O sea, yo creo que Ecora está haciendo las cosas bien, pero a veces el mercado no entiende bien pues, las transiciones o unos cambios importantes en la compañía. Ecora en el 2012 era una compañía de carbón térmico y metalúrgico. Hoy solo queda el activo de Kestrel de metalúrgico y en 2-3 años pues ya no estará. Por tanto, cualquier inversor pues, que le interese Ecora tiene que ver 2-3 años en adelante. Es decir, porque hoy no estás viendo la realidad de lo que será este negocio, ¿no? Aún así, el mercado está penalizando mucho a Ecora, también a otras compañías. No es la única compañía, ya habéis visto las valoraciones a las que cotiza. Pero repito, a mí me recuerda un poco, salvando las distancias y salvando los sectores, a Basic Fit, que es una compañía también muy penalizada en el corto plazo porque la gente no está viendo, no es capaz de ver la oportunidad a 2-3 años vista, ¿no? Tanto en el caso de Ecora como Basic Fit, uno tiene que analizar el cash flow que va a generar ese negocio pues, en 2-3 años, 2026-27. Eso es importante porque si tú no estás dispuesto a visualizar ese plazo, pues evidentemente probablemente esa inversión no sea para ti, ¿no? Simplemente es mi reflexión, ya sabéis, no es ningún tipo de recomendación, tenéis el disclaimer al inicio y espero que os haya gustado este update muy rápido, ¿vale? Sin querer ser exhaustivo porque ya hemos hablado de Ecora, seguiremos hablando. Hay catalizadores, tanto en Santo Domingo, en cobre, como en Voice Bay, cobalto, a lo largo del año, ¿vale? Y por otro lado, ya sabéis que tenéis la escuela que está funcionando muy bien. Ya puedo decir que es una escuela en toda regla. De hecho, tiene más alumnos que muchas escuelas de finanzas tradicionales de Barcelona. Por tanto, muy contento. Sabéis, a modo de resumen, que hay 2 cursos. Uno es el curso avanzado, mes y medio de duración en directo. La próxima edición será en octubre de este año. Hay una prelista ya abierta en el perfil de Twitter. Perdonad, tenéis el enlace. Pero también hay un curso grabado, que es uno de los módulos que se dan en el curso avanzado, que es el curso 10K. Ahora hay un descuento de 50 euros durante este mes de junio. El que lo quiera aprovechar, pues es un curso enfocado a la contabilidad, al análisis de 10K y sobre todo a entender las notas a la memoria, que es algo que veo que cuesta y que requiere cierta formación. Pues por eso está este curso. Y también, antes de terminar, ya sabéis que si queréis formación continua, bien porque habéis sido alumnos de los cursos, bien porque queréis formación continua, pues tenéis el club, que también somos muchos miembros ya, está funcionando muy bien. Hacemos análisis de todo tipo de compañías, no solo compañías de calidad de crecimiento, compañías cíclicas, dipcíclicas, royalty, rates. Los alumnos tienen acceso a todos los modelos en todos los análisis. Esto es diferente de muchos clubs, por lo tanto el alumno puede acceder a los Excels que se utilizan para modelizar las compañías, puede acceder a los screeners que hay, pues screeners de small caps, de rates, en muchas temáticas diferentes, masterclass, entrevistas, conceptos contables, un Discord que funciona muy bien. Por tanto, el club es el espacio de formación continua, repito, para alumnos y no alumnos, con 2 sesiones, un mínimo de 2 sesiones al mes. Y ahora también tenéis el pago anual, que hasta ahora solo había el pago mensual. Simplemente te puedes matricular un mes y si no te gusta te puedes dar de baja. Pero si prefieres pues, hacer un pago anual, que sepas que ahora también lo puedes hacer. Mañana el directo, pues como siempre, a lo largo de la hora y media que expliquemos, en este caso, 3 ideas de inversión, small caps, pues también hablaremos algo de la escuela, que repito, estoy la verdad que muy contento porque no era mi objetivo principal, pero la verdad que está funcionando muy bien, los alumnos están muy contentos, ya empiezan a subir los testimonios de la última edición del curso, por tanto, os invito a todos a leerla. Por tanto, espero que os haya gustado este update. Seguiremos haciendo updates de compañías que puedan ser interesantes. Hay muchas, ya sabéis que somos el único canal, al menos del sur de Europa, que entrevista a CEOs, lo seguimos haciendo porque aporta valor y dado que siempre tengo el contacto con las compañías, pues no está de más que vosotros, a través del chat, en una entrevista en directo, le podéis preguntar directamente al CEO, como hemos hecho hoy en Marc. Por tanto, me despido ya, un saludo y nos vemos mañana a las 19:45, donde veremos 3 compañías de 3 temáticas diferentes, es decir, una compañía que puede ser deep cyclical, otra que puede ser crecimiento, ¿vale? Vamos a mezclar a partir de ahora compañías. Yo que también es el único canal donde se habla de cualquier tipo de compañías, no estamos sesgados solo en compañías deep cyclical, solo en commodities o solo en compañías de calidad o solo en compañías de crecimiento o solo en compañías large caps, es decir, hablamos de cualquier compañía, si es verdad con un sesgo de small caps, porque así al final pues puedo generar ciertas sinergias. Así que os espero mañana a 19:45 en el directo, suscribiros al canal si no lo estáis, compartir este contenido en vuestras redes sociales, cuantos más seamos, más capacidad tendré para traer entrevistas de CEOs, tanto españoles como internacionales, dejarme en los comentarios propuestas de entrevistas a CEOs, CFOs que os gustaría que trajera al canal. Un saludo, buenas tardes, nos vemos mañana, hasta luego.